This was possible due to management's proactive measures on the raw material side during FY22, coupled with robust value chain created over the years. During the quarter, we continued to grow at our historical run rate with stable margins, and I will let Vishal discuss this detail during his remarks. We continue our focus on being an environmentally sustainable manufacturer. We have engaged DuPont Sustainability Services for creating the decarbonization roadmap. We are also proud signatory to the 10 principles of the UN Global Compact. Last year, we had commissioned a 12.5 megawatt solar power plant, and this will significantly reduce our Scope 2 emissions. We have taken further expansion of our solar plant capacity by 5.4 megawatts, which is expected to operationalize in September of this year, thus further reducing our Scope 2 emissions as well as our energy cost. Further, we have voluntarily procured barren land of about 20,000 square meter in Jagadia GIDC for tree plantation. Our target is to plant over 1,500 trees at this location. As responsible corporate citizens that cares for its community, we will continue to augment our green journey in the coming years. I am happy to inform you that the integration of 10 QFAC with Anupam is progressing as per plan, and I will let Anand discuss these details with you. Our investment and R&D to strengthen our product pipeline, improve our proceeds, and develop existing and new products using green chemistries. In order to fortify this, we are continuously hiring more talent in R&D team. During the quarter, we added 8 more professionals, taking the total strength of our R&D team to 85. As we go forward, our growth drivers will be strategic acquisitions, R&D, infrastructure development, quality product development, and we will be a reputable source of raw materials for our partners. I will conclude my remarks by stating that our investment through the years, particularly in the infrastructure, technology, human capital, green initiatives, and commitment to our customers, supported by strong balance sheet and experienced management team, will keep us ahead of the curve. I would now hand over the floor to Mr. Anand Desai, our Managing Director, to take over the proceedings and address you all. Thank you.
Thank you, Dr. Patel. Hello and good afternoon, everyone. Welcome to our Q1FY23 earnings call. I'm happy to update you on the business performance for this quarter. As Dr. Patel mentioned in his opening remarks, we have delivered a robust growth in Q1FY23 against the backdrop of an uncertain global environment. Our operating revenue grew by 31% on a YOY basis. Our focus on customer satisfaction by ensuring a consistent supply and operational finesse has helped us keep our gross margins and Ebitda margins steady. We believe 26 to 28% is a sustainable range for the EBITDA margins in the coming quarter. It is very important for us to highlight our strategy, which has helped us to keep our margins steady and customers happy. One of the important levers of sticky clientele is supply continuity, along with product innovation, process improvement, and cost leadership. To ensure supply continuity, we source and store our raw materials as well as finished goods in adequate quantities. This has helped us enormously during last year, especially with increasing supply chain concerns across the globe. We were able to ensure steady supply to our customers well in time because of this strategy. As you are aware, that our contract is structured on a cost-plus basis. Now, when I say cost-plus, all costs, including raw materials, freight, energy, commodities, inventory holding cost, and other overheads are on a pass-through basis. I hope this presents a clear picture of our contracts and how our inventory holding strategy has helped us to sustain our margins in such challenging times. We have delivered consistent supplies during volatile environment, which ensured consistent production plan for our customers. And this has led to our customers revising their volume guidance upwards despite the increasing prices of products. With this, we are now very confident of delivering a strong growth in the current financial year as well as on our existing product portfolio. Our strategic foray into fluorination chemistry continues as per our plan. We have identified 14 products under fluorination chemistry, and we plan to launch 6 to 7 products this year. We will launch them using our existing capacity. As we all know, we have acquired Tenfac with the aim of securing the supply chain and backward integrate our existing as well as new products in the fluorination lineup. The Tenfac integration is progressing smooth with the successful integration of key areas like finance, IT, and HR. We have already started working with the Tenfac team closely on the operational front. I am happy to share that we have successfully expanded the capacity of certain Tenfac products with process improvement and debottlenecking. During the quarter, we have added a leading Japanese MNC as a customer. I want to highlight here that in 2018, we had just 1% revenue from Japan. And we all know how tough Japan market is to crack. I am delighted to inform you that as of Q1FY23, this market contributes 13% to our revenues. We will continue to increase our presence in Japan, particularly as well as other geographies by onboarding new clients and increasing the wallet share of existing clients. We continue to make investments in infrastructure, R&D, human capital. During the quarter, we strengthened our human capital across the verticals, such as R&D, process optimization, flow chemistry, operations, business development, project management, sustainability, and safety. Anupam has been able to attract senior talent in the industry. One of the examples of this is that we have onboarded senior technical professionals in R&D, especially in fluorination chemistry. On the business development side as well, we have been strengthening our international presence by adding senior resources in Europe, Japan, and USA. We are also in advanced discussions with a couple of clients where the products are under validation, and which we believe that both the contracts should get signed in the coming quarters. Overall, I believe we have an exciting year ahead of us, and we at Anupam are all geared up to deliver strong, sustainable growth in FY23. With this, I hand over to Ebitda.
Thank you, Anand sir, and good afternoon, everyone. It's a pleasure to give you the business outlook. As Dr. Patel mentioned, we have commissioned a 12.5 megawatt solar power plant here and are progressing to commission another 5.4 megawatt by Q2. Currently, we are saving over rupees 12.5 megawatt solar power plant. This new investment combined with 12.5 megawatt plant would have total savings 14 crores per annum from FY24 onwards. Coming to capex for the year, this year our estimated capex plan stands at around INR 250 crores. The majority of this will be to cater the demand from LOIs worth INR 2,620 crores. Is signed during the year FY22. Please note that we will do this at the Jagadia facility as a brownfield expansion. Given that most other common infrastructure such as effluent treatment plants, etc., is already, the capex will mostly be related to machinery and civil setup. Therefore, we expect higher asset incremental ROCE. It is important to note here that we have close to rupees 200 crores on the books, which would be sufficient for the capex that is planned for the year. During the quarter 22, there was a worldwide supply.
We are losing your audio in between.
During the quarter 4 FY22, there was a worldwide supply disruption. In spite of this, select raw material was still not available. Therefore, our MNC customers specifically asked us to be a partner in tough times to sail through and help them to continue production run. This led to higher working capital, strategic call. This extension of support to our customers is helping us now in increasing wallet share, showcases the strategic partnership of our relations. Further, pricing mechanism clause in the contracts being revised to 6 months for significant part of the contractual revenue, and further, we have high focus on optimization, and the cautionary inventory which customers requested us to hold is expected to reduce significantly going forward. Now, I request Vishal Bhai to take you over the Q1 financial highlights.
Thank you, Amit Bhai. Hello, everyone, and thank you for joining us here today. I would like to briefly touch upon the key performance highlights for the quarter ended 30th June 2022, and then we'll open the floor for the question and answers. Before I proceed, I would urge all of you to go through the detailed presentation submitted to the exchanges and uploaded on our website. The financial highlights for the quarter ended June 30, 2022 are as follows. Operating revenue for the Q1 FY23 was at 3,066 million rupees as compared to 2,337 million rupees in Q1 FY22, driven by prices as well as volume growth. Total revenues were at 2,971 million rupees in Q1 FY23 as compared to 2,380 million rupees in Q1 FY22. Growth of over 25% YOY. The growth in the revenue was impacted due to the negative other income. We have certain liabilities in terms of borrowings which are in USD terms, and due to the sharp depreciation of INR against USD, and we have revalued them, leading to the higher other expenses. This is a non-cash item as it is purely a valuation of liability exercise. Ebitda, including other revenues, was at 845 million rupees in Q1 FY23 as compared to 650 million rupees in Q1 FY22. Growth of 30% YOY. This would translate into an EBITDA of 28% Ebitda margin in this quarter, which is an expansion of 112 basis points over the same quarter last year. Profit after tax was at 397 million INR in Q1 FY23 as compared to 321 million in Q1 FY22, a growth of 24% on a YOY basis. Now moving on to segment-wise performance for Q1 23. Our life science segment contributed around rupees 290 crores compared to rupees 205 crores in Q1 FY22. While other specialty chemicals contributed around rupees 14 crores compared to rupees 29 crores during Q1 FY22. In percentage terms, the life science segment contributed 95% of the total revenue, and the balance came from the specialty chemicals. As far as revenue breakup is concerned in terms of geographies, in Q1 FY23, the contribution from India was 38%, Europe 30%, Japan 13%, Singapore 15%, and the remaining 4% came from China. Export market continues to lead our geographical growth, and the trend is expected to continue during the year. Our top 10 customers contributed around 93% of the total revenue, and there is a total 24 products that we provide to them. This was mainly due to higher demand from top clients for the life science segment, We believe this will moderate to 80 to 85% level over the course of the year as we introduce new products along with rising demand of other products. With this being said, let us open the floor for Q&A. Thank you.
So shall we open the floor for questions? Hello.
Yes, please.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congratulations for a good set of numbers. My first question on the overall demand outlook globally, given the slowdown that we are seeing across Europe or US, while in your numbers there is still a continued growth both in Europe, Singapore as well as Japan, as you highlighted. So, any updates on your talks with the customers in terms of incremental business order? How should one look at that space?
Okay. Ankur, this is Vishal. I will try and answer this question to you. If you look at as what even Anand Bhai in his opening remarks mentioned, that even Anand Bhai mentioned about it, that because of the last year's performance and support that we have seen, our customers have been revising the volume demand that they have been offering to us. And what it means to us is that the demand is robust. We are looking at a high growth from our existing molecules as well as from the new molecules that we are planning to commercialize. So this is definitely a reassuring to us. And as we mentioned in our presentation and also in our media interactions in the morning, we have taken up a three-pronged growth strategy here, where we are expanding our current product portfolio to increase the volumes and revenue. Where even we are working with a lot of innovators, where they are yet to launch a new product which is under patent, and where we are working to develop intermediate as well as active ingredients for them. So that's something very, very strongly reassuring, and we feel very proud of that. Going on the other side, we are looking at commercializing all our LOIs and contracts that we have signed last year, which will further give us growth over the next few years. And the last one, as we had mentioned in the last call as well, that fluorination is also playing a strong growth for us. And as we had mentioned last time as well, that our hypothesis of the demand that we can cater to in fluorination was validated by a very large global consulting firm. And they have also come back and said that we would be able to target anything between $220 to $260 million of revenue in the medium term, all from pharma, agrochem, and polymers. So, Ankur, we are very, very satisfied and excited to look at this growth journey and continue this growth trajectory that we have had.
Sure, Vishal. That's encouraging. And just a clarification here. So earlier we had been highlighting a 25-26% plus revenue CAGR from a, let's say, 3 to 4 year growth perspective. With TANFAC coming in and the revenue potential which you highlighted, $220 odd million of worth revenue, will there be an upward bias to that number, or in other words, the core business will continue to grow at maybe 20-25% CAGR, and TANFAC led opportunity will be a top up to it?
Yeah, Ankur. So yes, there is two things I can say. One is a natural buoyancy that we are seeing in our own in our core business. Core means old molecules and all as well. As well, over and above the pharma and the new molecules are also driving it. So yes, there is a strong upward bias on the growth trajectory that we can see here. So I appreciate. I would tend to concur with you on that observation.
Okay, great. And just lastly on the pricing side, we did mention that the 6 month contract with most of the customers are in place, and Anand Bhai did highlighted that this is not only RM inflation but the overall cost inflation which is getting passed through. So right now, till now, the commodity prices were upward, in an upward trajectory, and hence the higher inventory helped us out. Theoretically speaking, if there is a sharp correction, or let's say a decent correction in the RM prices there, will that be taken care of in terms of our contracts with the customers, or there could be a one-time inventory hit? How should one look at it?
Ankur, I think in the past also we have mentioned, and I would want to I want to really share this with you, that the way we run our business is where there is a strong contractual relationship with our customers, and our customers really know what's the kind of inventory and at what level we have held them, and they are completely aware of it. All the price revisions that we see are in line with that assumption. So if you look at it from an inventory side, we do not have a price risk, as well as we do not have volume risk. We know that they are going to offtake in this time frame, and we know and we are comfortable, and the customers have clearly communicated to us that we would be acknowledging the cost at which you have acquired. So there is no price or a volume risk on this to say here. And also, when I'm holding this inventory, also my customer is also paying for that inventory holding cost as well. As Anand was mentioning, in the carrying cost or the price that we discussed with the customer, the carrying cost of inventory is also part of that calculation. So to that extent, Ankur, we do not feel any reason for us to have that inventory correction that we see. So that's not we are looking at. Yes, the only thing that the inventory cost can do, or the RM prices can do, is higher inventory holding or a lesser inventory holding in terms of value. That may happen, but beyond that, we do not see that happening.
Sure. That's encouraging. I'll get back into the queue with more questions. Thank you and all the best.
Thank you. The next question is from the line of Vidit from IIFL Securities. Please go ahead.
Hi. Thank you for taking my question, sir. Just a few clarifications on the current capacity utilizations and growth prospects. So what would be the capacity utilization of the existing plants, in the first quarter?
Hi. So our current capacity utilization would be in the range of 80 to 85%. However, I'll have to just highlight a couple of things, that the business that we are in, what we tend to do is also do, so there is enough room for our growth. Second, we are planning to invest in our capacity expansion, as we had mentioned. And three is that there is a strong room for us to do value engineering, which again gives us a growth, a potential to grow from the same capacity. So fairly, we are looking at a comfortable situation in terms of manufacturing capacity. Yes, we need to expand, in which we are undertaking for now. For us, future growth after a year or two.
Okay, got it. So currently your capex is the 250 crores that you mentioned. For the LOIs were 2,600 crores. Just in terms of those LOIs, what are the LOIs that have already started contributing to the revenue, and how much of LOI revenue can we expect going forward to value engineering and after the capex is made?
So two things. So if you see, there were 6 molecules that were there, of which 2 we had anyways supplied in the last financial year as well. 2 we will be commercializing this year, and 2 more we will be commercializing next year. Also, when we need the capacity, this capacity is required for the full volume ramp up. Initial part of it can be serviced from my current existing capacity as well. And hence, when we are saying that around 500 crores or 450 to 500 crores of revenue that we are expecting on an annual basis from these contracts should be ramping up in another 2 to 3 years' time.
Got it. And would you say the same for the 6-7 fluorination molecules as well? That would also take around the same amount of time to ramp up to the 220 to $260 million that you mentioned.
No, so what we mentioned about the fluorination molecules we have identified. So let me just dwell a bit on that. We have identified around 14 new molecules which we are looking at commercializing in next 2 to 3 years time period. And this on a potential basis, as we had mentioned, that we are looking at $220 to $260 million of revenue on an annual basis when they have fully ramped up. So that's the kind of number we are looking at for now. But yeah, it will take that time in terms of launching and also ramping up. This year we are looking at commercializing 5 of them, and they will have their own trajectory as we go forward. And when we are suggesting that we will continue the growth journey and the growth momentum, we are including this also in our plan.
So just roughly, would you be able to share what the 5 molecules potential could be at full ramp up?
Full potential. I would I would put it as a basket rather than try and identify 5 and say so. But as I'm saying, 14 would. If you see our presentation, also we have said that 14 molecules are where we are commercializing with $220 to $260 million. So the 5 will be of in the similar proportion.
Got it. Okay. So just last question on your tax rate was that the last couple of quarters we've seen a tax rate around 33-34%. So what can we assume? Like firstly, the tax rate was roughly 26 to 28% earlier. So what has led to this rise in tax rate, and what can we assume for FY23 and beyond?
So FY24 onwards, we should be looking at around about 30%, 25 to 30%, which will depending upon our MAT and other credits that we will take up, and that will be the case here. So we would want to keep it at that level.
Okay. Fine. Thank you so much. I'll just get back to you for more.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Rohan Gupta from Edelweiss Financial Service. Please go ahead.
Yeah, hi sir. Good evening and congratulations on such a strong set of numbers in a challenging environment. Sir, a couple of questions. First is on your presentation, you have mentioned that almost 7 molecules in FY23 will be in a list of with a $10 million plus, which was against close to 4 molecules, which was in FY22. So, if you can just share that all these 7 molecules which you have, where you have a growth visibility or the size visibility of $10 million plus, they're all they include 4 of the last year, or they are the new molecule which you are expecting? And how do you get this kind of visibility in that for the year they will be 10 million plus? And are they from the same set of customers, or they are coming from the new set of customers?
Ron, thank you for highlighting this. And first, a clarificatory answer. The 7 molecules includes the 4 as well. So additionally, there are 3, if that's the way to see it. So basically 4 plus 3, total 7 will be there. Yes, these are all molecules from my existing product portfolio itself, which is growing. And in terms of our confidence that we can see of this is basically because if you see, we have been working with when even in the opening remarks also when we had mentioned that because of the every year we have a discussion, as you know, every year we have a discussion with our customers on their volume. So based on their volume projections, we are able to say that this is the number that we can see this because these are the volume forecast and the price forecast that they mentioned to us.
Okay, so sir, definitely if it's just on a ballpark number, if I assume that each product is $10 million plus, and then almost close to, 700-800 crore rupees plus revenue should be contributed by these 7 products itself. Even if I just take that 10 million also as a base case, so almost at a 80 crore rupees minimum, so at least 600 crore rupees kind of revenue should be coming from these molecules itself. That is the kind of visibility you will have. I'm sure that the growth and overall revenue will be driven by many more such products. So just wanted to understand that when we're talking about the growth trajectory of the company and the guidance of 25%, if you're looking at, does this consider all these kind of development, or this is over and above that all those development which you are factoring in the numbers when you are guiding?
So when we are guiding, I think the guidance also, I have mentioned that there is a strong upward bias in terms of our growth numbers. So what we have done in the last couple of years is the kind of a growth rate that we will be seeing here. First. 2, yes, when we are suggesting this kind of a growth rate, we are taking into account various factors, as we mentioned, in terms of what our clients have and customers have provided in terms of offtake guidance, in terms of our conversations and our commitments that we have seen from our customers in terms of commercializing the new molecules as well. And that's where we come from when we are guiding these numbers. So in that sense, we are having a far more comfort and visibility in terms of our revenue. I will just want to just share it again for our my benefit, that the kind of business that we are in, it's a more contract driven business, contractual driven business, where we have long-term relationships and long-term a demand that we work with our customers, which gives the management in the organization to have a longer term view in our business development activities. We have a strong visibility in terms of revenue, and not only visibility and stability both put together, which really helps us in focusing on developing newer businesses and not worry about my repeating the same business. Because when I start my year, I don't start with a zero revenue. I practically start with an 80-90% or 100% of my revenue of the last year. And also my customers are giving me a visibility for the year as well, and that includes a part of the growth as well. So I'm really worrying about only my growth for the next growth, which I wanted from 2 or 3 years going forward. So that's where we really see ourselves in this business. I hope I have answered your question.
Yes, sir, that's pretty helpful. So just one more clarification. You mentioned that roughly 93% of the revenues last year came from almost top 10 customers. So just wanted to understand a little bit more in terms of the customer concentration. Would it be possible for you to share top 3 customers? I mean, are we completely dependent top 2 to 3 players for our large part of the revenues? Would it be possible to share revenue from top 3 customers?
So let me make it in a different manner. Probably I may not be able to let me try and see how much I can expand on this. If you see my top 10 customers, as we said, this is the number, but you have to also look at the 24 molecules are there in it. So it is not only one customer and one product. We do one product, one customer, yes, but one customer, many products. Okay, so that's one thing. Second is 93 is more a statistical number in this case, because it is only a quarter number. Now in quarter, what happens is that if there are delivery schedules which have been preponed or postponed by our customers, that happens. But if you look at from an annual basis, we would be seeing a number around 80-85%, which we have seen in the history also, and that's where I would say. And I can only confirm that client concentration of top 3 is also not significantly high. I would say it will be in the proportionate range that we have seen. Right.
Okay. Okay. And so just last bit from my side, and I'll come back in queue. So you mentioned that in the fluorination you have the agency which you have hired has given you some $250 to $260 million kind of addressable opportunities in the product portfolio and basket which can ramp up. So in this $250 to $260 million opportunity, do you see that the product which you have identified, you have mentioned that close to 14 products you have identified in fluorination chemistry, and 7 to 8 you will be launching in this year. So this 14 products, this $250-$260 million revenue opportunity for those products, or is the total universe which they have given you, and then you will be part of this? And what kind of revenue potential from these 14 products in the fluorination chemistry which you are planning to launch can be?
So if you see, what we were saying is how I'll narrate how we went about estimating this business, and also then how we are seeing it. If you see, fluorination is a chemistry which we've been working on for last 5 to 6 years, and here we were working on the fluorination through KF. Now with TenFat, we are now able to commercialize the products which we could not commercialize, which were based on HF. So what we are right now talking about is newer commercialized products. Now we knew we have done the R&D and the pilot development of all these products largely in our R&D plant and in our facilities, and also have conversations with our customer. Now when we acquired TenFat and when we launched the plan for commercializing these products, we went to this agency and said that these are the scope of products that we are looking at to commercialize, and please validate that for us. That what we believe this is the kind of a exciting opportunity and potential that we have, and we asked them that could you revalidate it for us, and that's where they came back and said the addressable market of these 3 segments in the fluorination for this is around $5 billion. But of which they are saying that what we have been focusing on the molecules and the molecule series that we have been focusing on is $220 to $260 million. And so for us, we would be expecting to look at these kind of numbers in the longer in the near term to longer future. If you see the slide number 11 in our presentation also, that's what we are trying to say. So that is revenue potential for Anupam.
Got it, sir. Sir, thank you so much. I'll come back in queue for the follow-up question.
Welcome.
Thank you. The next question is from the line of Krishna from JM Financial. Please go ahead.
Hi, sir. Thanks for the opportunity. So my first question is basically on the 6-month pricing. So just wanted to check whether it is done for all the customers or not. And just to follow up on that, what kind of inventory levels that are expected for this year and the next year? I'll ask the second question after that.
So one is that a significant contractual revenue has been moved to 6 monthly one. That's what I can say on this thing. And in terms of inventory, we have seen the downward trajectory of inventory days, and we should be able to see a significant inventory days reduction by the year end.
I'm sorry, Vishal, I didn't catch that answer of 6-month pricing, whether it is done for all the customers or not.
It has been done for the significant part of it, not all, but significant part of it.
When we say significant, that is 70-80% or 50-60?
Around 60 to 70%.
Okay, great, thanks. And the second question is only on the capex guidance. So what kind of a capex guidance do we have for 23 and FY24?
So FY23 I can give you. FY24 I would wait for a minute, but on FY23 we would be looking at around 250 crores of capex that we would do.
So I understand, the 24 is something that you would like to wait, but just to understand, would that be in a similar range or could it be higher?
Ceteris paribus in the similar range, but I would not want to commit for now, because as we go, there are a lot of world is dynamic right now, and there are a lot of things happening. So I don't want to make any commitments or guidance on that for now. If it's okay by you. But
sure.
Right. But, huh?
Yeah, I think that is helpful, and thank you for the opportunity, and good luck for the future. Thanks. Bye.
Thank you for that.
Thank you. Next question is from the line of Bhavya Gandhi from Dalal & Broacha. Please go ahead.
Yeah. Thank you for the opportunity. Sir, I just wanted to understand what would be our debt levels in FY24, long term and short term.
That's a bit of a crystal ball gazing to make an answer for that. So 24, I can't say. What I can say is today, and what we say, our debt levels are similar to what we had in the year ending FY22. For 24 and all, right now we don't have any guidance to give for now. The only right, but we would definitely see there would be a correction in the or reduction in our long-term debt that anyways would happen as we have our cash flows which will service the debt. But right now we have no guidance for that.
Fair enough, sir. And from a ROC perspective also, our margins look very extraordinary, but from a ROC perspective, we are still struggling. So we are, somewhere generating 10-11% ROC. So can you just throw some light over there? Maybe I understand high inventory levels and all those things, but beyond that, because last 3-4 years I continuously see drop in our ROC levels.
Yeah. So let me address it in a little that one. If you see when we started our capex plan 5 years back, our revenue was around 340 odd crores, and we did a capex of around 800 crores. So if you look at that kind of revenue and whatever kind of Ebitda margin that we would see, that would significantly have impacted our ROCs. Before that, our ROC was in the range of 30-35% plus, but that brought the ROCE down. Of that 800 also, if you see, there was around about 200 odd crores of capex, which was largely into non-revenue generating, if I were to say, like additional land, additional infrastructure and others. So that led to our lower. But as we see in the last 3 years, my ROCE and ROE both metrics are seeing an upward trajectory now. And we see that as we fully sweat our assets and also use our non-revenue generating assets like your civil infrastructure which we have created when we expand and when we see the land being utilized, this number is going to significantly go further up. And so we should be looking at around about 14% ROC this year is what we are targeting.
If you could just throw some light about our competitors, who remains a competitor in the CDMO business?
I would not want to get into that competitor kind of a conversation, but if you really see that this business is not where we are competing with each other in the country. This business is a very large potential for India as a total, and if I were to see competition, then probably we are seeing competition. We are competing with Europeans and the Chinese, Europeans to a large extent because my customers are moving their demand from Europe to India, and that's more coming not because they're switching off from them alone, but there is additional volume which comes to India, and there is some bit of moving from Europe to India as well. But this is such a large business. If you see India's specialty chemicals market and the segment that we are in, there is humongous opportunity for each of us. I don't think either of us are competing with each other, be in terms of molecules or be in terms of this. So I really feel that actually as an industry we are growing. I don't see that I need to take business from my peers. I don't think that's happening for either of us.
Thank you. Mr. Gandhi, I'll request you to come back in the question queue for a follow-up question. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and congrats on a good set of numbers. So first question, again, delving a little bit on the fluorination part, the 14 molecules that we have identified. So here, where are we currently in terms of the R&D or pilot stage, and when can we expect the first commercialization happening? And when we are talking about $220 to $260 million, is it a yearly potential or is it for a period of time? Thank you.
Okay, the first thing is in terms of R&D and others, if you see that 5 molecules we are looking at commercializing this year. So that's the kind of readiness that we have. In terms of most of the molecules, we have a large part of R&D done. There is a bit of a pilot or validation process happening in few of them. And the second question that you had asked was the potential. Yes, it is an annual potential that we are talking about. On an annual basis, we should be looking at this kind of revenue when we fully ramp up these molecules.
Right. Thank you. Just one clarification. So here, are we talking only about fluorination chemistry, or probably we have something else in terms of our chemistry knowledge that that makes us probably a better fit than other competitors?
So, the molecules that we are talking about here are all fluorination molecules. This part, when we're talking about this conversation and when we talk about slide number 11 of our presentation, we are talking about only fluorination as a thing. But please understand that this is also part of a very, very two or three things I want to add here. One is that we as an organization has been able to demonstrate to our customers, existing and potential customers, that we are partner of choice. We are reliable, high quality, technologically driven, suppliers to them, and we would be preferring to be part of the supply chain rather than their supplier in a more narrower manner, and that has led them to show that kind of a confidence. And if you see in terms of these molecules, what we are talking about, these are all strategic molecules, very high value niche molecules that we are talking about, and whichever very high value accretive molecules. But that's how we are seeing this in terms of our relationship with our customers. Yeah.
Right, got it. Just couple of bookkeeping questions. First, in terms of Q1, 25% growth rate, how much was from the volumes and from pricing?
So our growth rate was fairly divided between revenue, volume, and price both.
Sure. And FY23 guidance in terms of revenue and Ebitda margins.
So revenue, as we have said, we have mentioned about our revenue trajectory which we have seen in the last 2-3 years is what we will be looking at. So I think this quarter's number also reflects exactly what kind of revenue growth. In terms of, I'm talking about operational revenue. You would have, what you mentioned was my consolidated revenue with other incomes. But if you look at my operational revenue, the growth number, we should be able to see similar kind of growth number. And two, in terms of Ebitda margin, yes, we have a good healthy Ebitda margin. However, if I were to guide or to suggest, if we were to suggest that, we would look at 26 to 28% on a conservative basis. There is a upward bias on that, but I don't want to mention that for now and say that we would be looking at 26 to 28% at least in terms of Ebitda margin. Is where I would leave it for now.
Got it, sir. Thank you so much and best of luck, sir.
Thank you.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Hello, good evening and thank you very much. Can you hear me? Hello?
Yep, very much.
Yes, yeah. Thank you very much. So the first thought is you had taken a board approval for a QIP of 800 crores. So what is the status of that and what is the rationale for such a large fundraising exercise? You already say that you have about 200 crores of cash. I would like to understand what is the thought process behind that.
Okay. So this is only an enabling resolution. There is no firm plan as of now in that activity. As and when we have anything firm, we will come back to you. But as of now, it is only an enabling resolution.
Okay. The next question is on TANFAC. So you've invested about 300 crores, as we understand. You have 25.8% stake. So in terms of the investments you made for the process improvements and capacity augmentation in TANFAC, what is the amount of investments that have gone in and how much of that has gone from the Anupam balance sheet? And secondly, how do you see the JV share of TANFAC Industries moving, say, in the next 2 years? Given your plans to use their products for Anupam as well as expansion within TANFAC?
Okay. So Ramesh, just a clarification here. We have used 150 crores, 156 crores to be precise, in acquiring the stake here, for that reaching to 26%. But 154 crores to be precise, and the expansion that would happen as and when that happens in TenFact, that would come from their own balance sheet. Today they also have a cash and they have an independent board who would decide, though we are part of them and we are the management shareholders there, but that would not be moving from the Anupam's balance sheet. It would go from the TenFact's balance sheet and on their own strength that they will do the capex there. So there is not anything much that would go from Anupam's side.
So in terms of the original thought process behind the TenFact acquisition, you were planning to take 51% stake within Anupam Rasayan, right? And you were planning to invest 300 crores. So what has changed, and how does the current stake change your ability to use that potassium chloride for Anupam, and your own ability to even influence their investments in HF derivatives, which is a big opportunity you're looking at. So where do you go from here, from this 25.8%, and the value you derive from the investment? How should we read that?
Okay. So first, let me so two parts to your question. Part number one is about the stake that we have acquired, and two is our ability to look at the synergies from this acquisition. So first is that when we did a acquisition of 25% stake of Birla, that triggered an open offer, and I'll come to why it triggered and then what we did about it. That triggered an open offer that go up to 26% stake, open offer for up to 26% of the stake. When we ran the open offer, we got around 0.8% of shares of the company, and hence we ended up with a 25 odd figure in terms of our shareholding, right? 25% shareholding of the TenFact. So that's where. So when you remember, it is 25 plus 26, it would be in this context. And hence, if it was the total, then it would have been around 300 odd crores of revenue of amount. But open offer only offered so much to us. Now coming to the synergy and our ability to have that synergy under the joint. So the reason that we triggered an open offer primarily was because there was a change in management control. Because our relationship with so this whole relationship originates from a joint venture agreement between TIDCO and Aditya Birla Group, and where we are replacing Aditya Birla Group in this joint venture, and hence the management control comes to us, which triggered the open offer. Because if you technically look at it, it was 24 point something only. So we did not have gone for an open offer of that size. But we went ahead because of the change in management control. And because we have a management control, our ability to synergize and create synergies is intact. Either we are at 26% or we are at 51%.
Okay, fair enough. So one last thought, in terms of your capital expenditure of 250 crores and your ability to capitalize on the fluorination opportunity. So yeah, in terms of the benefit from this capex, how much would that be in terms of adding to capacity and tonnage? How much would that improve your process capability? And how much of capex are you planning for monetizing this fluorination opportunity here this year?
So is that this capex is principally for the monetization of the LOIs, and that's where we will be, and that would help us generate to satisfy all the LOIs that we have signed. Because if you look at it, we are looking at about additional revenue of around 450 to 500 crores, and that will be generated through this capacity addition that we would do. Fluorination, as of now, we are not requiring the capex right away, because these are the molecules we are commercializing from our existing plants where we have a capacity. So we do not see too much for now.
Okay, thanks a lot. I will join this.
Thank you very much. Ladies and gentlemen, due to time constraint, that will be the last question. And I'll hand the conference over to the management for closing comments.
I once again thank everyone for joining this conference, and we would want to take this opportunity to thank each of you who have shown tremendous confidence in the management and has stood by us in this kind of a volatile environment. And for that, we thank each of you and hope that we will live up to the expectations of each of our stakeholders, including customers, employees, and our shareholders. And thank you, all of you, for coming, and hope you have a good evening. If you have any further questions, please feel free to reach out to NY for any follow-ups or any clarifications. Thank you, and good evening.
Thank you very much. On behalf of Anupam Rasayan India Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.